What's up, y'all? Hey, so I was listening to Jim Rohn, and he said that it was a study done among prisoners where they kept going back to prison because of their lack of knowledge. So that's why I've been posting this financial literacy. That's why I've been posting these words, because if we understand these words, then we can understand like what to do with our money, where the money goes, what is money, things like that. So I'm creating another course. I feel like from prison to properties, that was a good movement. A lot of people jumped in, a lot of people got into real estate, but I want people to actually understand investing. Real estate is not for everybody. So therefore, I want to do something where I can give something to everybody. And teaching people these financial literacy, these words, these actually implementing these things, how to implement them, that's going to be the next movement. So that's what I'm doing today. I'm going to go over A to Z, all of these words that I've been posting, and just try to give you a clearer understanding of what they are. So the first one is going to be acquiring assets. So as you know, an asset is something that put money in your pocket. So we thinking on the terms of investments. We're not just thinking about having something that's worth something. We thinking about investing, having money come into your pockets. So for me, my first asset was a duplex that I bought. I lived in one and I had a tenant paying me to live in the other. So therefore it put money in my pocket every month. So if I would have went out and bought a house, a regular house, it wouldn't considerably necessarily be an asset. And the reason why is because I have to go to work, I have to pay for this house. This house brings me no money. It costs a mortgage, it costs a light bill. So that's not really an asset. So an asset is going to be something that put money into your pocket. So whenever you're thinking about an asset, think of something that you can buy one time that can pay you forever. So let's say you wanted to start a clothing brand. You make the product one time and people go online and they buy it. For me, I made a book. That was an asset that I made. So that's what an asset is. For B, we're gonna go into buying bonds. What is a bond? I know you hear people talk about stocks and bonds all the time, but what is a bond? So a bond is it's basically you loaning money to a company. So let's say you see a company like Apple, they selling bonds. What they doing is they acquiring money. They getting money in from people. They getting loans in. It's a bond, and they'll pay you back with interest. That's what a bond is. So the government, they do bonds. Big companies like Apple, Facebook, all of these companies, they sell bonds too. The thing with bonds is they are a product that the company sells and it give you a very small return. So let's say you give a company $100, they'll give you $105 back in 3 years. That's a guaranteed return. But the thing is, you gotta wait 5 years for just, well, 3 years for just $5. So that's what a bond is. A bond is you loaning money to a company. And the good thing about bonds is because with a bond, it's guaranteed. So if the company go out of business, if it's a big company that go out of business, you'll get paid before the stockholder get paid. So that's what a bond is. The government issue bonds all the time and things like that. It's a good way, it's a good safe way to put your money into something where you don't have to worry about it. Credit. What is credit? So credit is simply you borrowing money, all right? A credit card. You hear about building your credit and things like that, your credit score. Credit is basically like your score on how good you are of paying back what you owe. So let's say you get a house or you get a personal loan from a bank. That's your credit, right? You take your credit and you buy more assets with it. So an asset is something that put money in your pocket. You taking credit to buy the assets. That's what I love to teach. And whenever you understand this concept, then the money gonna come in forever. because it's called an infinite return, where you didn't put nothing out of your pocket and you getting money to come in forever. So that's kind of like what credit is. Some ways to build your credit is what I did was I got added as an authorized user on one of my friend's credit cards when I got out of prison. So I didn't have very bad credit, but I didn't have good credit. So when I got out of prison, they added me on a credit card and it boosted my credit up because I got all of their credit history. So that's one way to boost your credit. Another way is to get more credit cards. Another way is to go in the bank and ask for money and pay the money back. Those is ways to build your credit. And credit is so important because nowadays we can't get nothing without good credit. So I advise everybody to work on their credit. Just get your credit score, see where your credit is at. Some people just never knew about credit, but credit is the way that gets you ahead in life. Most of us, we're not ahead in life because we never had the opportunity to use credit as leverage. If you use credit, just imagine you getting $10 and you making $100 off of it. That's a way to build your, that's called leverage, and that's a way to build your future, build your financial future. So dividends. Dividends is money being paid to you from the company whenever they make profits. So let's say a company like Apple sell 1,000 iPhones and they made 100,000 in profit. If you own stock in Apple, they'll pay you a percentage of that profit. That's called dividends. Another way to get dividends is if you buy, I like to think of it as me getting paid rent, right? I bought this building and every month it pays me to own this building. That's a dividend. A dividend is simply money coming in from you owning something, right? So whether it be stocks, whether it be real estate, anything that keeps coming in, anything that keeps that money coming in, that's your dividend payment. Equity. What is equity? So whenever we're talking about real estate, equity is what you owe minus what the building is worth. So let's say you got $100,000 building and you owe $50,000 on it. You have $50,000 in equity on this building, right? So equity is basically like money in the bank that you can access, you can go get, but you don't necessarily have to. That's what equity is. And you can have equity in a house, you can have equity in a business. Like if you and your friends started a business, you would have 50% and they would have 50% equity in the company. So whenever the company start making more and more money, that means you'll have more equity in the company. So F is for futures. What is futures? Futures, whenever we're talking about the stock market, futures is what you think the stock will be tomorrow in the future. That's why they call it futures. It's what the future holds for a stock. So let's say the stock market is at 1,000, and you think that since Christmas is coming, everybody is going out and spending more money, spending more money. So therefore, you think the stock is going to go up. So in the future, that stock is going to be worth more money. So that's what futures is. You can trade futures on almost anything. They trade futures on corn. They trade futures on what the stock market going to be. They trade futures on everything. But I don't do that. I know how to do it, but it's just, I like to stick to one thing. And my one thing is real estate. So for G, we got gold. What is gold? So gold, as you know, is a metal, right? But this metal, it doesn't tarnish, it doesn't fade away, it don't get bad. So that's why we use gold as something of value, and we've been doing it for 5,000 years. Gold has been valuable for 5,000 years. Nothing else has been valuable that long. And the reason why it's valuable, the reason why we use it today is because our money is it used to be tied with gold, but now it's not. So when our money goes down in value, like let's say um, an outbreak happens and our money is worth less, it's worthless. So we can't, like nobody wants it. Like if nobody wants your money, it's worth less, right? They already have money, they already have the products that they need, so they don't need the money. So your money is gonna go down. Now, a way to stop your money from going down is holding it in gold, right? So when the price of eggs go up, that means you're getting less eggs for your dollar, right? If you had $1 and eggs cost $1, but they went up to $1.50, now you can't even get a whole thing of eggs, right? Because your money went down in value. But if you had this piece of gold, this piece of gold would still be worth the same amount as it was before the dollar went down. So that's why it's important to own assets that appreciates in value. Gold appreciates in value. So H is for hedge. What is hedge? Hedge is what I'm talking about with the last example of gold. Gold, you hedge your money to fight inflation. So you will buy gold, and that when the dollar go down, then your gold will be worth more, and that's the way to hedge your investments. So let's say I I had $100,000 in the bank, and everything went up in price. Everything went up. So now I can't buy what I used to be able to buy. But if I had that $100,000 in gold, that means I hedged my investment. So that's what hedge is. That's for H. I is inflation. What is inflation? Inflation is simply your money becoming worth less. It's worthless. So inflation happens just like supply and demand. We all know what supply and demand is. As the supply goes up, the demand goes down. So that's inflation. That's basically what inflation is. Whenever the price of everything is going up in value, like houses is going up, cars is going up, that's inflation. And the reason why it's doing that is because our dollar is being printed. They printing more money. They printing money. Like whenever they gave away the stimulus checks, they printed a lot more money. So it's a lot more money in circulation. So therefore, we don't need all of that money, right? So instead of just burning the money or whatever, they just gonna raise the price on things. So that's inflation in a nutshell. So for J, we got joint account. A joint account is just simply you and your wife or you and your husband on the same account. That's pretty self-explanatory, so I won't go under that. K, we got knowledge. So knowledge is what I give you. Knowledge is this video right here. You have the knowledge, but knowledge is, they say knowledge is power, but knowledge is only powerful if you implement the knowledge. So all of this information I'm giving you is worthless unless you get out there and you implement some of the things that we talk about. So for L, we got leverage. What is leverage? Whenever we talking about credit and using credit as leverage, that just means that it comes from the word lever, and a lever is something that you use to lift something, right? You just get more leverage with this thing. So what is leverage is you using credit, like a credit card, or going to get a loan and using it to buy something bigger. So in my case, I use credit. I use my credit card to buy a house. And now the tenant that's in the house pays back the credit card every month. So that's what leverage is, using other people's money to make more money with it. That's how I like to put it. So for M, we got a mutual fund. What is a mutual fund? Whenever we're talking about the stock market, we got we got Apple, we got Facebook, we got all of these companies. All of these companies into one is what we call a mutual fund. So somebody else deals with all of the companies that's in this basket. We call it a basket of funds, a mutual fund. Some person deals with all of these companies. They sell them, they buy them whenever they want to, but you just give them the money and they handle the money for you. If you want to get into the stock market, that's a good way to get into the stock market without having a lot of knowledge. You're just paying somebody else to do all of the work for you. That's what a mutual fund is. And you can buy mutual funds on anything. You could buy them on real estate. You could buy them on technology. It's a million mutual funds that you can go out here and buy. So if you want to get into the stock market and don't know what you're doing, that's a good way. So for N, we got net worth. What is your net worth? You hear people talking about Jay-Z and Diddy, they billionaires and stuff. That's what they worth and everything. But your net worth is what you are worth minus all of the things that you owe. So if I have $1 million in real estate, but I got a mortgage that's $700,000, my net worth is only $300,000. That's my net worth. What you have minus what you owe. That's your net worth. Kind of like when you look at your check and it's like off, you be like, man, what's this? So there's your net worth. So an option. Whenever we're talking about the stock market or real estate, we got options. What is an option? An option is what it sounds like. It's the option to buy or the option not to buy. We got options. So I'm gonna use the real estate market as an example. So an option is I can buy this property on this day for this price if I want to. I give you a premium, I give you a down payment, and I can buy this. I have the option to buy this property. That's what an option is. It's the same for a stock market too. You got the same option contracts in the stock market as you do in the real estate. So that's for O. P. P is passive income. What is passive income? Passive income is income coming in that you don't have to work for. So I produced a product and I sell the product without me being present, and I get a check in the mail. That's passive income, where I made something one time and I don't have to work again to get paid from it. So real estate, my book, stocks, those is all ways that we get paid and we don't have to go out and do work for it. So active income is you going to work. You have to go to your job to get paid. You have to actively get paid to do these things. Passive income is whenever it just passively come into your account. So the more passive income you got, the easier it'd be to go to the Bahamas and chill for a year if you got that passive income. Q is going to be quarterly reports. What's a quarterly report? A quarterly report is when a company open up their books and show you what they making every quarter. Every 3 months, they open up their books and say, hey, we spent $100,000 on products. We spent $50,000 on expenses, light bills and logistics and all of these things. That's a quarterly report. And we made $50,000 in profit. All the big companies, they have to do this if they have people called shareholders. If they have shareholders giving them money, they have to open up their books and let people see what they actually making. So that's what a quarterly report is. For R, we got real estate. What is real estate? Real estate is buildings, it's billboards, it's trailers, it's storage units, anything that people rent out that's a property, right? one of the best ways to get passive income is those storage units, because you don't have to do nothing. You just give a person a key and they pay you every month to store their things in this place. That's a piece of real estate. I like multifamily real estate because you got all of these tenants that's living there that's paying you every month, and you have to do little to no work. So that's what real estate is. It can also be a billboard. That billboard, somebody pays to put their logo, somebody pays to put their promotion on that billboard. So that billboard is just sitting there on a corner, and people is paying for you to be able to use it. So for S, we got stock. What is a stock? A stock is ownership in a company. That's the easiest way to put it. When you hear people talking about stocks and bonds, that's what it is. It's ownership in a company. So let's say you got an iPhone, or let's say you wear Nikes every day. If you own this company, they will pay you a dividend to own this company. So let's say Nike is your favorite brand. You can go to a brokerage firm, TD Ameritrade, Schwab, all of these brokerage firms, and you can buy the stock. So now you actually own Nike. That's what a smart consumer does. They own the products that they spend their money on. So if you're using Colgate toothpaste, go out and buy Colgate. If you using American Energy, go out and buy some of their stock. And when they make profits, they'll pass some of the profits back down to you. So basically, it's like you getting your stuff at a discount. That's what a stock is. Anybody can do it, and that's the best way to get in the game of investing, by being a smart consumer. We don't produce anything, right? We're not out here producing electricity, right? So why don't you own a company that produces what you need on a daily basis? And that's by owning stock in the company. T. For T, we got treasury bonds. So whenever you hear about America printing money, they are printing it and they selling bonds, right? So what's happening is the government is they selling bonds, all right? So you can give the government $100,000 and they'll give you $105,000 back in 3 years. That's them selling money. So that's how we get roads built. That's how we get schools and teachers and things like that, by the government selling bonds. And that's how they make their money, that and taxation. So with these treasury bonds, is almost guaranteed that you're gonna get your money back, because America's not going out of business no time soon, right? The way the economy is, they might be going out of business. Nah, but all bull aside, like a treasury bond is basically like you buying into America, right? And you can do that. It's called a T-bill, and that's a good way to store your money away, where you can make extra money off of it. For you, we got unrealized gain. So what is an unrealized gain? So let's say I bought a building for $90,000, and the building went up. Now it's worth $130,000. So now I got $40,000 in what we call equity, and I haven't touched it yet. I'm $40,000 richer, but I haven't touched it yet. So that's a gain, but it's unrealized because I haven't went in and cashed it out and got my money. So that's what an unrealized gain is. And you can get these unrealized gains in the stock market also. When you buy a stock for 100 and it go up to 120 and you didn't sell the stock, that's an unrealized gain. Now, when you sell the stock, that's gonna be a realized gain, and that's a taxable event. That's when you gotta pay the taxes on what you just sold, right? So that's what an unrealized gain is. For V, we got venture capital. What is venture capital? Venture capital is when um, you basically like getting money from capitalists. A capitalist is somebody that's capitalizing off of their money, right? So a venture capital firm is a group of people that loans money to, like, let's say when Nike first went public, they was a good company, they made a good shoe, but they didn't have the money to get in front of all of these people. They didn't have enough money to make all of these shoes, so they needed capital to produce all of these shoes and stuff like that. So they went to a venture capitalist, which was a loan, a bank, or something like that, and they loaned them the money. So that's what a venture capitalist is. It's somebody that loans you money on a big scale. We're not talking about $15,000. We're talking about $150 million firms is getting this venture capital so they can go public and sell their product to the whole world on a stock exchange. So that's what a venture capitalist does. They basically loan you money, kind of like Shark Tank. If you ever seen the show Shark Tank, that's what they do on that show. They venture capitalists and they loan money. W gonna be wealth. What is wealth? Wealth is how long you can sustain this way of living without having to go back to work. So wealth is the money coming in. So like, let's say my bills is $6,000 a month, right? And I have rental properties that pay me $10,000 a month. So they pay for itself. So now I got $4,000 extra every month. I don't have to do nothing, right? That's what wealth is. When you have more coming in off of your assets than you have in expenses. So the wealthy people, they don't have to work for money. Their money is working for them. So how long can you sustain this way of living without having to go back to your regular job or whatever? For why, we got, I didn't have an X. I couldn't figure out nothing for X. So if you know something, just type it in the chat and we can come up with it. I think exchange traded funds was on my list for X. So exchange traded fund is an ETF, and basically it's like a mutual fund. It's a whole bunch of companies all in one. So let's say we wanted to buy every company that's in the stock market. That would cost a whole lot of money. We don't have money like that. So they put all of these companies into one fund and it moves just like the stock market. So that's called an ETF. You could buy the whole stock market at a fraction of the price. So I like to use SPY. SPY is the S&P 500, the 500 biggest companies in America. And it costs about $450 to own all of the stock market. That's what an exchange traded fund is. That's what I use for X. For Y, we use yield. What is a yield? A yield is the percentage that you're making off of a product, off of an investment. So your yield. So let's say you spent $100 on this product, on this investment, and it gave you back $150. So you made a 50% yield. 50% yield. So that's how you determine if an investment is going to be worth it, by the yield that it makes. So you do 100 divided by 50, and that's the yield that you get. So if you want a 7% yield over 7 years, double your money. So if a 7% yield is a good yield. We won't get 50s and 100% yields realistically. So for Z, we got zone of support. What's a zone of support? Let's say that we know that the stock market or the housing market or whatever it is at this level right here. And it goes way up to this level. Whenever it start going back down, that's the zone of support. That's where it usually is. That's how we usually know where it's supposed to be at, whenever it's right here at this zone of support. So when you're buying things that's overpriced, you know that it's gonna go back down. But this right here is the level of support where it's supporting that's a good buy. So when you find things that's below that, that's when you buy, because you know that it's gonna go back up. So I just went through that alphabet of investing just to give you some insight on some of these words that we don't know what they is, how we determine, like the thing I opened with was something Jim Rohn said. He said is a direct correlation between the people going to prison and financial literacy. Well, not financial, but just literacy in general. So if the dumber you are, basically putting it like this, the dumber you are, the more likelihood you are of going to prison. That's crazy. That's insane. Because I'm not smart, I go to prison, and it's the statistics prove it, but it's just crazy because we don't educate each other. We just don't know it. So you can't be mad if you don't know something. You just got to seek the knowledge, and that's what I'm here for. I'm here because I'm trying to just get the knowledge out. What if we could all be millionaires? What if we could all not have to worry about money, right? Then we'd be in a good place, right? Because Maslow's hierarchy need is food, clothing, and shelter. As long as we got food, clothing, and shelter, we good, right? But then what comes next? What's the purpose next? That's what we seeking. That's what we looking for. So by you knowing these words, by you knowing what a dividend is, you can look for one, right? But if you never heard the word dividend, you obviously not gonna look for it, right? So that's what I'm here for. I'm gonna turn this video and this teaching into a course where I'm gonna be teaching this stuff. Not only just, I don't want to just tell you the words. I don't want you to just know what an asset is. I want you to be able to identify one, go out there and buy one, and then we can celebrate together whenever you acquire one. So that's what my mission is. So From Prison to Properties was the first movement. It was about real estate. But now I want to teach you about investing in general, because real estate is not for everybody. Broken toilets and terrible tenants is not for everybody. So I want to give you something that's probably more up your lane. So that's what I'm building out now, from inmate to investor. Stay tuned.